Good morning, shareholders. Thank you all for joining us today for our FY22 annual results presentation. Operator, if you could move to slide 3, please. I'd like to start off with a summary of what we do as a company. Very briefly, we build big equipment called photon-assay units. We deploy them to our customers, which are miners and laboratories, and then we charge them a fee for use over a long equipment lifetime. Photon-assay is a gold analysis technology which uses high-powered X-rays to measure gold in a sample. Analysis is a non-discretionary spend for miners, and we're displacing an existing analysis technology called fire assay. And we're seeing rapid adoption of our technology all over the world because it's far superior to that incumbent technology, fire assay. First developed by CSIRO, photon assay is significantly faster, reducing analysis time from hours to minutes. It's more accurate, particularly where miners have complex mineralogy. It allows reduced sample preparation, which reduces overall analysis cost. It's completely automated. A technician only needs to place a sample onto an input conveyor and then remove samples from an output conveyor post-analysis. It has reduced labour requirements. A number of our partners run both fire assay and photon assay in the same facility, and they've informed us that they need only 1/3 of the labour to run photon assay compared to a similarly sized fire assay operation. We dramatically improve health and safety for operators, where they're no longer exposed to hazardous lead and to hot furnaces. Every sample also reduces carbon dioxide emissions, and we have zero waste that comes out of that in comparison to fire assay that produces a contaminated lead waste. Finally, photon assay samples are 10 to 20 times the sample mass that's processed for fire assay, leading to a more representative subsample for analysis. As a snapshot of our company operations and business models, we've been commercially running since 2018. And that was originally with our MinAnalytical partner in Perth. We're now deployed successfully across 3 different continents, and they represent the key target markets for our technology. We've analysed in excess of 3 million commercial samples to date. Our customer contracts work on a long-term service and lease agreement with high-quality counterparties. They're typically for a period of 5 + 5 years, and on average, on an annual basis, they generate between 47% and 82% of their build value as return on invested capital. Each of our agreements includes a minimum monthly payment due to Chrysos by the customer, providing secure, forecastable baseline revenue. And we also make additional revenue when customers run samples in excess of those monthly commitments, which for FY22 accounted for around about 22% of our photon assay revenue. On the back of a very strong year of sales, these lease agreements now stretch out to deployments into 2025, which supports our ongoing manufacturing growth. First of all, we have no viable competitors that we've identified, and our technology is well protected by a mosaic of patents on a global basis. Photon assay has quickly become accepted by the industry. It's been used for JORC and NI 43-101 compliant releases, and we're seeing fast penetration into our total addressable market, which is estimated at over 600 deployments worldwide. We've been growing more or less exponentially since our first deployment in 2018, and we're on track to do so again in FY23. Can you please move to slide 6, operator? Moving on to the results for FY22, which are our first full year results since our IPO in May of this year. Starting with revenue, we had total revenue for the year of 14.3 million, which is a 215% increase on our FY21 revenue of 4.5 million. It exceeds our prospectus forecast by 3.8%, and 13.5 million of this figure is made up of photon assay revenue. We're also confirming that we are on track to meet our FY23 prospectus target of $26.6 million, which is an uplift of 86% on this year's revenue. Our FY22 pro forma EBITDA grew by 2.2 million on FY21 to a final value of 1.45 million, which is notably a 57% increase on the prospectus forecast of 0.9 million. This is largely due to a reduction in operating costs and company expenses. As with revenue, we confirm that we are on track to meet our FY23 prospectus guidance of 3.2 million. Total contract value is a measure of the minimum future income that we'll receive from the units that we either have deployed or have contracted to deploy into the future. It's effectively the sum of all of the minimum monthly payments due throughout the expected term of the contract. The variables that go into this contract calculation on a unit-by-unit basis are the price per sample, the committed monthly samples, which together make up the minimum monthly assay payment. We then take this number, multiply that by the expected term, and that is our TCV. By analysing the TCV of each of our new sales announcements over the past 6 months, it's possible to see that the strength of our contracts continues to increase, aligned with industry adoption. We now have a TCV of $705 million, which is up $258 million as a function of our recent sales. From a funding perspective, we currently have $92 million in the bank, and we're operating cash flow positive. Any cash flow generated is reinvested into the manufacture and deployment of new PhotonAssay units. Our cash position sees us well funded to continue to deploy PhotonAssay units over the coming financial year. After signing 23 new lease agreements in FY22, we now have 48 contracted units, 11 of which are already deployed. Throughout the year, we've expanded our manufacturing capability, that's within Chrysos, our contractors and subcontractors, to a total of 12 units per year, and we're in the process of further expanding this to 18 units per year, which will be achieved by the end of FY23. Having 48 contracted units, 37 of which are still to be deployed, we have strong support for our growing manufacturing capability. Lastly, for this slide, we finished the year with 10 operating PhotonAssay units and have had a further unit deployed since, bringing us to a total of 11 operating units. Our deployed units are operating in line or a little above prospectus forecasts from a utilisation perspective, completing the year with an average of 66% utilisation. We've grown our deployment team throughout the period and are currently installing 3 different units around the world simultaneously. This is a huge milestone for Chrysos. We're currently installing a unit in Queensland with Ravenswood Gold, another in Perth for ALS, and another in the Ivory Coast with MSA Labs. We're on track to meet our prospectus forecast of 21 PhotonAssay units operating before the end of FY23. Slide 7, please, operator. Notably, throughout the period, we've added 2 new organisations to our order book, that is Alfred H. Knight and Britannia, and we've also seen the expansion of our relationship with Intertek to include deployments into Africa. We're happy to be broadening our customer base with each new customer offering something a little bit different to the last, and I'm pleased to say that the different business models of our customers are fitting together nicely. Next slide, please, operator. The chart on the left shows a breakdown of our quarterly revenue over the last 18 months. Minimum assay payments, shown in yellow, grow in line with each newly deployed unit. Of the 11 units that we currently have deployed, we have a secure revenue stream of $1.3 million per month, which equates to $15.6 million annualised. The additional assay charges, which are shown in grey, illustrate the excess revenue that we receive from our deployments, where our customers process samples above their committed minimum. In FY22, the AAC accounted for 22% of PhotonAssay revenue, up slightly from FY21, where it accounted for 20%. Our other revenue here includes revenue from the sale of consumables, which reflects investment in our upstream supply chain, ensuring that our customers have continued access to PhotonAssay sample jars. This represents a small proportion of our revenue. With 10 more units to deploy this year, we'll see continued growth in both the minimum monthly payments and in our additional assay charges. Next slide, please, operator. I would hazard that this is the most important slide in the deck, and I want to take some time to explain what this chart actually means. Reflected on the chart is what we call our return on invested capital, or ROIC, as a function of utilisation. Firstly, ROIC is the unit revenue minus the related operating costs on an annual basis. It's effectively the gross profit generated by an individual PhotonAssay unit. From left to right, as utilisation of the unit increases, we move above the minimum assay payment and experience improved returns from the units, which corresponds with increasing additional assay charges. On the left-hand side, we're supported by those minimum monthly assay payments alone. The important point here is the change between the grey line and the orange line, where we've seen material shift upward in our ROIC since our IPO in March. This shift upward is both at the left-hand side and the right-hand side of the chart, which means that we've managed to both increase our minimum monthly assay payments on average but we've also increased the price per sample on average across our units. Translating this into specific financial metrics, we've seen an increase in the minimum return of a unit from 34% up to 47% per annum, which is an increase of almost 40% on the unit economics that we went to the IPO with. Where units are run at or near capacity, there is a 76% additional revenue available as additional assay charges over those minimum returns. Put more simply, on average, if the units operated at only their minimum payments, then a PhotonAssay unit would generate $1.75 million in gross profit per year. And this is in comparison to our previous average gross profit of $1.2 million per year, which is obviously a material uplift. At high utilisation, a PhotonAssay unit on average would return $3.2 million in gross profit, which is almost the entire value of a PhotonAssay unit on an annual basis. Remembering as well that these PhotonAssay units have a very long equipment life. Effectively, for each new unit that we deploy, we create a high-value, sustainable revenue stream with strong upside potential. Finally, for this slide, we've talked before about clustering units in our key regions around the world, and this clustering strategy allows us to further reduce the operating cost of our units, driving additional ROIC from that which is shown on the chart. Slide 10, please, operator. On the right-hand side, this chart should now be familiar to our shareholders. The black line represents the monthly samples processed and corresponds to the right-hand axis, while the yellow section is the average utilisation of our deployed units, corresponding to the left-hand axis. We continue to see sustained high utilisation of our units and are repeatedly hitting record volume months. As we deploy additional units around the world, we fully expect that this will continue. FY22 saw us process around 2.2 million samples around the world, and we've expanded now into each of our key target markets, East and West Africa, Canada and Australia. And we will now proceed to cluster units into each of these regions. I'm now going to pass to Brett Coventry, Chrysos' Chief Financial Officer, to talk us through the financials.
Thank you, Dirk. It's great to be confirming our results and the achievement of our prospectus. Operator, I just want to make sure we're on slide 12, please. Let's look at the pro forma results on a profit and loss basis. Pro forma revenue, as previously advised, is in line with expectations. The underlying and Unity-style PhotonAssay revenue of $13.5 million for the year is a 208% increase over the FY21. A great result. PhotonAssay costs, in my view, an important call-out. We are starting to evidence when we have units clustered together, the cost of their operations is reduced. The other savings this year has been on spare parts consumed in providing maintenance. This has also been seen in cash flows, with slightly less investment in sustaining capital expenditure. The improvements in employee costs come from timing and efficiencies in our team. We remain on track with hiring growth, and we now have over 60 people in the organisation to support the growth plan. A strong outcome for pro forma EBITDA of $1.45 million against the prospectus forecast of $925,000. Slide 13, please, operator. As we've spoken about Chrysos throughout the year and the IPO process, we have talked about positive operating cash flow, and we are pleased to confirm this has continued for the financial year. This means the capital raising we've done and the future debt facilities we are working to implement face towards our deployment of PhotonAssay for growth as opposed to funding the business. While this operating result was lower than forecast, this is largely a timing issue significantly due to putting in place our international corporate structure to allow for invoicing in appropriate jurisdictions. This meant a high volume of invoices raised towards the end of the financial year. Growth CapEx variance is very much a time issue, particularly focused around when we are required to pay for our units. As we've spoken about before, approximately half becomes due when the PhotonAssay unit is handed over to the customer. So as it becomes income producing, it also incurs a liability for payment. Slide 14, please, operator. Reconciling these pro forma results to the statutory number, we've touched earlier on consumables, revenue and costs, which saw our statutory result exceed our prospectus forecast. The other material call-outs include non-cash expenses relating to the reduction in the provisions for payroll tax on share-based payments of $850,000. And while we have strong counterparties, we have also accounted for an expected credit loss of $169,000, not in the previous forecast. Of course, equity raising costs, the Series C and IPO in the results also impact the statutory accounts. These are taken into account in the statutory profit and loss in both finance cost and tax expense. The tax expense is the impact of the capital raising costs taken to equity. Next slide, please. My focus here is our strong balance sheet position, primarily as cash and increasing towards non-current assets. That is the key takeaway, is strong cash availability to deploy growth through PhotonAssay. Lastly, securing a debt facility remains the biggest question from analysts and investors alike, allowing Chrysos to continue the growth trajectory well past the forecast period. We are progressing discussions, but nothing that is able to be announced at this stage or that would benefit our negotiations. We are working with finance partners that continue to grow with us, and as by the time we've deployed our current capital, we are a significantly larger business and our needs to continue to evolve through this time. As you have probably calculated, at our planned growth rate of 18 units in FY24, we don't require further funds until well into FY24, and we remain confident of being able to announce something in the first half of 2023. Thank you.
Thank you, Brett. Slide 17, please, operator. Looking forward from here, the company will continue its aggressive growth story with another 10 units on their way this year. We're on track to meet prospective targets for revenue and EBITDA and continue to expand the customer base with Tier 1 counterparties around the globe. With deployment contracts now extending into 2025, we're well supported for the growth of our manufacturing capacity to 18 units per year, and we're well funded to deploy our upcoming units. I'll now open the floor to questions.
We will now begin the question and answer session. If you wish to ask a question, please press star then 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press star then 2. If you are on a speakerphone, please pick up the handset to ask your question. At this time, we will pause momentarily to assemble the roster. And our first question will come from Josh Kannourakis of Barrenjoey. Please go ahead.
Hi, Dirk and Brett. Thank you for taking my call this morning. First question, just with regard to pipeline, could you give a little bit more colour just with regard to what's in the pipeline at the moment, how conversion's going versus how it's historically going, how the economics are setting, given you've also, the last couple have obviously been at higher economics, but maybe just a little bit more colour on the pipeline, the underlying sort of potential customer base and economics, please.
Absolutely. No, thanks for the question, Josh. Look, from a contract strength perspective, I think you can pretty clearly see the ongoing increase in the strength of those contracts. We're seeing an increase to minimum monthly assay payments, an increase to price per sample, and essentially that comes through and showing the increase to the TCV. With regard to customer conversion, there's an obvious linkage here between customer conversion and deployment timing. So we want to make sure that we are converting customers at least the rate that we are going to continue to deploy units. So winding that forward to 18 units per year, you should fully be expecting that we're announcing in the order of 5 unit sales per quarter as just business as usual. There's a very, very strong pipeline. We're seeing excellent industry adoption. Some of the things that we called out specifically in our 4C were around Barrick's continued adoption. Second biggest gold miner in the world after successful operations at their Bulyanhulu project, are now taking PhotonAssay to the DRC for their Kibali project as well. So that's a particular vote of confidence for us, and we fully expect to be seeing the top tier gold miners and top tier laboratory companies as well continuing to pick up our technology.
Okay, great. And just with regard to just maybe one for Brett, just talking on the cash side of things, just to clarify, Brett, when you're talking about cash burn and funding and the like, are we talking FY or calendar years in terms of sort of first half 23 in terms of the debt facility being sort of locked away?
We would expect to be able to announce something in the first half of calendar year 2023.
Yeah, and then likewise for the other cash burn, meaning, back end of calendar 24 is sort of when you're referring.
Certainly materially into FY24, yes.
Yep. Okay. No, that's great. Just also final one for me, just with regard to obviously, the market environment, people have observed in terms of exploration, expenditure maybe being a little bit softer. A few results have come out today from some of the drillers still being very strong. Can you comment, I guess, just in terms of maybe a little bit more just around current trading, what you guys are seeing in terms of sort of, the volume equation at the moment and how that's sort of flowing through to your customers?
Yeah, look, that's something we pay close attention to. There's obviously two sides to our business. One is the operating miners, and the other is those exploration volumes that are going through the central hub and spoke laboratories. So what we've seen anecdotally, I think that there is less heat in the market at the moment from an exploration perspective. There's a bit of an improvement in turnaround times, but we haven't seen any impact or any direct narrative to PhotonAssay impact. So if anything, we're seeing that continued adoption. I think we hit an excellent spot in the industry for driving initial adoption of our technology when turnaround times were becoming quite obscene. We saw a lot of miners picking up the technology because really they had no alternatives at that time. What we've seen now is that those miners that picked it up are continuing to use it and, if anything, accelerating their use of PhotonAssay. So even while there is potential that the exploration market in particular might be turning down a little bit, we're not seeing any impact on our operations or our narrative with ongoing sales with our potential customers.
Yep, no, that's great. And final one for me, just with regard to how we should be thinking about, I guess, the actual where the units are deployed in terms of mine site versus lab. Maybe just talk through how we should be looking at that in terms of the next 12 months and then, longer term, what you think that split will be.
Yeah, absolutely. So certainly at the moment, you can tell that our deployment schedule is laboratory heavy, and that's intentional. We see laboratories as the best way to get penetration into the miners. From a really simplistic point of view, a laboratory can service multiple miners. So for every PhotonAssay unit that you deploy into a new region, you're able to service these miners, get them comfortable with PhotonAssay technology. On the longer term, or even medium term, shall we say, we would fully anticipate having a larger degree of miners compared to laboratories. If you look at our total addressable market, it's about 1/3, 2/3 between laboratories to miners. We would anticipate in the longer term that we would be looking to approach that. I personally feel that the long term here for Chrysos is a definitive skew toward miners over laboratories.
Got it. And just with that regard, in terms of the mine sites, how many of those do you think are operated by, I guess, the lab operators versus some of the miners themselves typically?
We typically put it at about 50-50. You probably find there's a little bit more than 50-50 run by labs for the miners on their sites. But for us, it hasn't been a key metric because we're happy to work either with the laboratory company or with the miner directly. One of the key differentiators here is that for miners that want to announce their results to market, whether that be JORC compliance or NI 43-101 compliance, they'll often seek an independent assay laboratory. So where miners are running all of their exploration samples on the mine site as well, they're often supported by one of these TIC laboratories. However, we do see a number of instances where you'll have those miners sending their exploration samples to a hub and spoke laboratory, but then running their own laboratory on site. But for us, it doesn't really make a difference one way or the other. The unit economics are very similar for us, whether it's on site directly to the miner or on site via a TIC laboratory.
Okay, that's all from me. Thank you, guys.
All right, thank you, Josh.
The next question comes from Stuart Oldfield of Field Research. Please go ahead.
G'day, gentlemen. Dirk, you made a reference there to expanding the manufacturing capability. Could you tell us a bit more about that, please?
Yeah, absolutely. So we've been quite vocal about the number of units that we can manufacture per year. We probably use the term fairly liberally. When I talk about manufacturing capacity, I talk about Chrysos' ability to deploy units, so the size and skill of our deployment team. We talk also about our upstream manufacturing from NukeTech, which is around the sort of the base build of the unit itself, and then our integration capacity in Adelaide. So effectively, every different component that is required to assemble and deploy a PhotonAssay unit. So right now, all of those different aspects, we could manufacture in the order of 12 units per year, so 1 unit per month. and we're growing that at the moment to a capability to deploy 18 units per year.
Got it. And have you examined scenarios where you could reduce your reliance on that base build partner? Is there an alternative?
Absolutely. I think there's always a question here around single supplier risk, and it's a double-edged sword. Having a single supplier is excellent because it means that every single unit around the world is the same. We can maintain and service these units with a team of Chrysos and Nuctech employees, but certainly it's something that's on the radar that we may not want to be beholden to a single supplier in perpetuity.
Got it. And what happens to the unit economics if you do have to switch to an alternative base build provider?
I think the unit economics will come down to the individual componentry of the unit, and we would certainly be looking to find a CapEx that is similar to our current base build cost.
And that currently exists?
Sorry, as in
an alternative currently exists?
Yeah, look, so there's key components to the unit. So part of the equipment is an automation system, and automation systems are fairly available all around the world. Probably the key component that has that single supplier aspect is around the linear accelerator. But linear accelerators are a well-used technology around the world in the medical industry, and particularly in sterilisation, of about the same physical size as we use for one of our units. So there are alternative individual component manufacturers around the world that we could then integrate from.
Got it. And finally, just a point of clarification, you made a reference to the using the Nuctech to install a unit on a mine site. Nuctech staff need also to be present?
Yes, so we have a pairing of Chrysos and our contractors on site for an installation.
Excellent. Thanks for that.
No worries at all. Thank you, Stuart.
There are no further questions at this time. I'll now hand the call back to Mr. Dirk Treasure for closing remarks.
Thank you very much. We're really pleased with the performance of the company this financial year. It's been a particularly big one for Chrysos. We're focused now on deploying additional units around the world and further growing our customer base. Look, I look forward to providing further updates as we go forward. So thank you all for attending.